At the moment, the funds are majority allocated to actively managed equity strategies with a bias towards the home market in each case. For the balanced funds, they have around about 45% in equities, and for the growth profiles, they have around about 70% in equities. That exposure across all the portfolios is balanced by some fixed income exposure. Again, it's higher in the balanced portfolios, around about 40%, lower in the growth portfolios at around about 17%. And within there, there's a strong bias towards corporate credit in particular, where we see better valuations. And then furthermore, those exposures are balanced with exposure to listed infrastructure and listed real estate asset classes as well. On the whole, the Harmony portfolios performed well in the first quarter. The US dollar funds were up 1 to 1.5%, and the Asian funds were up 1.5 to 2%, both in US dollar terms. The balanced funds in each case outperformed the growth profiles because the fixed income portions of those portfolios performed better than the equity portions. The opposite was the case with the sterling funds, which were up 3 to 3.5% each in sterling terms. The equity portion performed better there than the fixed income. The laggards over the quarter within the fund range were the Europe Diversified and Australian Dollar Growth funds, down 2.1 and 2.6% respectively. The headline performance for the Harmony funds over the quarter disguises a lot of market volatility over the period. However, over the full period, developed market equities ended down by 2% in local currency terms, whilst emerging market equities posted a small gain of just over 3%. Global bonds in local currency terms again also gained a little over 3% for the period. But even those numbers also disguise a lot of divergence underneath that in terms of sector performances, regions, currencies, etc. Thinking about the main drivers of Harmony performance, which was generally positive over the quarter, the contributors to that, or the biggest contributors, one of them was our exposure to interest rate sensitive investments. So that's not just fixed income, but within equities, listed infrastructure and listed real estate both performed very well over the quarter. Secondly, another theme in markets over the period was a very strong rebound in commodities that began around the end of January and continued through to the end of March. We had indirect exposure to that through two holdings, one being the Copernic Global Equity Strategy. It's a deep value orientated manager with substantial exposure to the materials sector. That strategy outperformed by 13% relative to global markets, so exceptional performance there. We also had small holdings across all the funds in a iShares Gold Producers ETF, which provides exposure to companies that mine gold. That asset class rallied also, posting a gain of around 50%, 50 in dollar terms over the period. So although we have very small positions there, by virtue of the risk that it contributes, that was quite a big return contribution there. Then also emerging markets performed well, and we benefited from that. And our manager that we use for exposure to that area across most of the funds is Dimensional. They outperformed the market as well. So that resulted in a gain of around about 9% in US dollar terms over the quarter. Then, as I said, the interest rate sensitive side of things did well. That included fixed income. Although our holdings didn't quite keep up with very strong returns that were demonstrated by government bond markets, our more credit-focused holdings in investment grade and high-yield credit performed very well. Also, our holdings in emerging market debt performed well. And those contributors were only partially offset by small declines from our convertible bond holdings over the period. So those factors all really contributed positive returns and explains the generally strong performance across the Harmony funds for the quarter. The exceptions, of course, were the European and Australian dollar funds, and that's really down to currency there, as well as some weakness in the local equity markets as well. In terms of currency trends over the quarter, the US dollar, having been very strong last year, weakened quite substantially during the first quarter. That was a tailwind for those funds with a US dollar-based reporting currency, and the same was the case for the sterling funds. Conversely, though, the European and Australian dollar funds, their currencies were very strong and therefore that resulted in a negative translation effect for their international holdings, and partly contributed to the weaker local equity market performance as well. So markets were exceptionally volatile in the first quarter. By early February, global equity markets were down 12%. We thought that this was overdone. We thought this was providing an opportunity to add to equity positions across the portfolios. So we did that. We added to our European equity and listed real estate holdings across all the funds around early February. We also made some changes within the fixed income component, adding to investment grade credit, where valuations had also improved during this sell-off period in markets, but also it's an asset class that's more defensive and balances off the increase in risk we were making elsewhere in the portfolios. We funded these changes by reducing cash holdings and selling what had been a successful investment in the Munich Emerging Market Debt Fund. It's performed very well in the last few months and held up well during this period, so we felt it was best to reallocate capital to areas that had underperformed. In the face of several structural headwinds globally, we remain in a low growth and low return environment. However, the major developed market economies are still growing, albeit unevenly. And economic data is continuing to improve, supported by ongoing loose monetary policy and solid corporate fundamentals. We recognise that markets have risen substantially over the course of this current cycle, but the recent correction in markets has done a lot to improve valuations and return prospects going forward from here. As a result, we have a positive outlook for the Harmony Fund returns going forward. Much of the positive return contribution over the medium term is likely to come from the equity portion of our portfolios and indeed of markets as well. There we expect mid to high single-digit returns. They're likely going to be lower in the US where valuations look high, but we expect decent returns elsewhere. Stock and manager selection is going to be key in this environment of high volatility. We expect that volatility to persist, and therefore that will create opportunities, particularly for active managers, and also for us as we allocate across different asset classes. But at all times we will retain a high level of diversification within the portfolios along various parameters, by asset class, by manager, etc. In order to deliver a good, solid return stream, we hope for mid to high single digits per annum over the next few years, but also with reduced volatility and reduced drawdowns as much as possible.